One of the differences between the property market and the stock market or the crypto market is that property is not fractional. And I'm going to spend a couple of minutes explaining what I mean by that, and then we'll jump into our outlook for 2026. If I've got $50,000 or $100,000 to invest and the property market moves, what usually happens is I'm priced out. With that 50 or 100 grand, when the market moves with that same amount of money, I now have to trade down on quality as to what I can go out and buy. With stocks, that's not the case. If I've got 50 or 100 grand and Tesla goes from 300 a share to 400 a share, I can still invest that 100 grand into Tesla. I don't need to trade down the quality of stock because those stocks are fractional. I can buy fractions of them and I can take my $100,000 and still invest in the same thing. Same thing with crypto. If Bitcoin goes up 10-20%, I can still invest 100 grand into Bitcoin. I'll get 10 or 20% less, but I'm still having that exposure. With real estate, the game is different. Because real estate is not fractional, what happens when the market moves is that investors look elsewhere and they trade down on quality. And that's where we are in 2026. We're going into a market where a lot of investors that have been investing in 2025 are going to have a completely different game plan. The game in 2026 is completely different. We're going to have a look at some numbers and just kind of see where the market has been and where the market's going. So that's a really important concept to get going right from the beginning, because we're going to use that in our analysis going forward. 2025 was generally a market that was positive. We saw a bit of a bounce. It wasn't a huge bounce. This is a rate of increase chart that I'm showing here. It's from Cotality, previously called CoreLogic. They put out some great data. And so what we can see is that there was a little bit of a bounce. Wasn't as strong as the COVID years of investing, but we still saw a bounce. And the reason for that bounce was based on sentiment that interest rates would be cut and the home guarantee scheme changes in October, which pushed more people into the market. Those two things may change in 2026. And interest rates are definitely no longer on the downward trajectory for the time being. That might change, but you can't, in the short term, assume that interest rate cuts are going to do the heavy lifting in terms of where you're investing in property. So that's very important. And that's going to dictate the markets that we're going to have to look at for opportunity. The home guarantee scheme has also been very popular, but there's political pressure in that it's bid up a lot of buyers. It's bid them out of the market. It's supposed to be helping first-time buyers get into the market, but because prices have pushed higher, that they might have to change and means test that. So those two things are no longer going to be there. And what's really important to understand this year is the rental yields. You're going to be having to go into markets where rental yields can sustain themselves, or there is legitimate capital growth opportunities. You can't have a wishy-wash of each. And so I think Canberra, Darwin, more so Canberra, I'm a little bit more positive than Darwin and Hobart. Darwin and Hobart have been bid up. They've got smaller markets. The price integrity there is perhaps not as deep as the bigger markets. And I think Sydney is going to be a standout in certain segments of the Sydney market. But this is really important because if interest rates stop coming down, you're going to need to see yields going up. Yields go up either by rental growth, which is going to happen in certain strong markets, or prices coming down. And so if you're in a market where rents aren't necessarily rising as strong, prices are going to have to stabilize or come down. So this is towards the bottom end of the chart pack. I've started there, but I wanted to really, really focus on basically where the price action has been. And this is the most important part where you need to be thinking about your interest rate differential if interest rates don't come down anymore. Let's go straight to the top and have a look at some of the key markets. I'll skim through the first few pages. This is basically just shows combined what's happened in 3 months to November. Canberra's obviously a soft market. Prices haven't really grown as much. I'm going to get into Canberra in a minute, but I'm going to start off with Sydney. Sydney will remain a premier market because it is the market where the economy is the strongest, where the infrastructure is coming on. We have a new airport coming online and opening. We've got a new metro, Southwest Metro, coming online. And so that network impact in Sydney and the absence of any real new significant supply, and most of the migration flows into the Sydney markets, that's going to bid up Sydney. The markets that have done well over the past 2 years in Sydney have been the outer markets, the cheaper markets, the markets that are more affordable. But we think that in 2026, the markets that are going to do well in Sydney are going to be those where you have rental income growth, and they're going to be the metro mid-market. That market has been sleepy, anywhere from about 5 kilometres to 15 kilometres within the CBD catchment. That's your inner west, your eastern suburbs, your lower North Shore. Anything along infrastructure is going to do really well, and we think that capital growth that has been sleepy over the past year or two will catch up this year. So that's the Sydney market. You have less fluctuations, as you can see in Sydney. It's more of a steady state market, but it's going to be, we believe, above 0%. There's going to be positive growth, and there's going to be real income growth, rental income growth. Melbourne's a market that's just finally catching its tail. It's starting to go up, but Melbourne still has depressed yields, and if Melbourne doesn't get rental income growth, if rents don't rise in Melbourne, it's going to struggle because interest rates are no longer falling, they're going to stabilise, and a lot of those factors like the home guarantee scheme might not need to be there. So Melbourne is on a watching brief. Brisbane's been a really, really strong market, but we believe in a concept called mean reversion. Things go back to their averages, and Brisbane's price growth has been phenomenal over the past 5 years, but it was really, really sluggish in the 10 years prior. So it's catching up, it's run really hard. And again, Brisbane is a market that starts to wobble a little bit if interest rates stay where they are, and particularly have prices have risen so much over the past few years, prices rising and interest rates not coming down. Potentially Brisbane starts to run out of puff, and it goes through a period like we saw between 2010 to 2020, that decade, that lost decade in Brisbane where nothing really happened. Adelaide market has been mimicking the Perth market and the Brisbane market. It's been playing catch up. It's still quite positive, but again, as Adelaide prices grow, those rental yields need to catch up, and if rental yields don't catch up, then there's going to be some price consolidation. Same thing with Perth. Perth is still very affordable. We've had big increases in terms of percentage-wise, but they're coming off a lower base. And so Perth is a different topography, has different drivers. We're a big believer in the mining boom and the prospects for mining in Australia, particularly with the electrification that's going on around the world. And Perth is probably a market that's going to do quite well, but rents need to rise. We think they will. And as they do, that's going to support the price action. Hobart has been a very volatile market. It has started to pick up. Darwin has had a big boom over the past 6 months. Again, the market needs to show that it has rental growth, and it's also a thin market. So we need to be very, very careful that these markets are not as big as your Sydney, Melbourne, Brisbane. They're markets that can be very choppy. And just have a look at this price action, in Darwin. Don't forget that you do get a lot of volatility, and you can have periods where that negative growth does eat into your return. So for those that believe in it, by all means, go into that market, but it's probably not high on our list. Canberra is a market that's been sleepy for a while. Canberra is a market that's had a lot of issues around supply, price growth has been sluggish, but rental yields are reasonable. They're about 4%. Apartment rental yields are above 5%. And the reason why I say Canberra's interesting is because of this. It's had very, very flat capital growth. No doubt there's been more supply, but we think it's a market that's going to catch up at some stage. In the same way that Darwin was sleepy for a while before it picked up, and same way that other markets, you can't really see it that much. with Adelaide and Perth because this time series starts from around COVID. But if you go back, 10 years between 2010 to 2020, there was a long period in these markets where they were sluggish before they took off. And we've seen the take off in Darwin. We could potentially see Canberra. And the reason also why we say Canberra is an interesting market is because the fundamentals behind the rental market are still strong. Government strong, government industry strong, defence is only going to increase, government services in the public sector in Canberra have remained quite strong, and the cost of construction in Canberra is increasing. And so that means any new supply coming into the rental market is going to be at an elevated rate. And we think Canberra definitely deserves to be on the watch list. It hasn't been one of the most favourable markets or the most popular markets, but we're quite contrarian and we think it should be on your list. So that gives you a little bit of an update and an overall view as to where the Australian property market is. Market in 2026 is going to be driven by the areas that can grow rental income. If your area doesn't have the ability to grow rents, if there isn't rental demand, it's going to be a tough market. Interest rates can no longer do the heavy lifting. Government programs are probably not going to be as generous. Some of that generosity is going to be wound back. And you want to be going into markets where this is where we started and this is where we're going to end. Your rental yield needs to be above 4% and your rental growth needs to be quite positive and strong. And rental rates have been strong in Darwin and in Hobart and in Perth over the past few years because they were coming off low levels. But it's all about which markets are going to continue to have that rental growth as the economy remains strong and as inflation starts to hold up. Hopefully that gives you a really good view as to how these markets are going to perform over this year. We're going to provide more analysis. We're going to give you more insights. There's a couple of thousand investors that get access to our emails every week. So make sure you follow us, reach out, talk to our team if you're an investor and you want to know what your options are before interest rates move. If you're looking at growing your portfolio, scaling your portfolio, if you're looking at getting into the market, if you're looking at changing an owner-occupied property into an investment property, all these scenarios, we're experts in them. We can definitely help you out and help you scale your portfolio. Thanks for watching. Make sure you subscribe and let us know what you think.